Welcome to Investment Portfolios. This is your online instructor, Diana Block, and today we're going to talk a little bit about asset classes. As you start working on your final project for this course, you will have to make some recommendations for assets on a fictional portfolio for a potential customer. Now, before we start ever moving money around, it's important that we have an understanding of the types of investments that could be made and how they relate to each other. So we're going to talk about investment classes, asset classes, and the major groupings related to that in this video. So when we talk about asset classes, we're talking about groups of similar investments. And so the major types of investment class we refer to most often is going to be company stock. This is the equity ownership shares of a company. And so for growth, we're normally looking for some stocks in the asset mix. We also could have debt. This is also called fixed income, and most commonly we're talking about bonds in everyday language. And with bonds or debt or fixed income, what we're saying is we're making a loan to either a firm or it could be a government agency. The federal government, your local government, county, school board, they all offer bonds or debt assets where you can receive a fixed income for your loan to that firm in the form of interest payments, and then your principal being returned at the end of the loan period. So that's stocks and debt. You can also have cash or cash equivalents. And cash or cash equivalents is just like it sounds. It's actual money in cash that's either in your savings account, in a pillowcase at home, in a safe deposit boxes. Most people will want to have an emergency fund in cash or very close to cash, but it's extremely liquid, of 3 to 6 months of their expenses. So cash and cash equivalents is going to be an important asset class that you will want to have evaluated for appropriateness depending on the customer. And then you also have some alternative investments, which might include real estate. So real estate, of course, is real property, homes, buildings, and land. Or it could also mean natural resources or precious metals like gold. So you have those alternative investments. So in general, the similar investment types that we have by group are stocks, which is equity, your bonds or debt, which is fixed income, cash and cash equivalents, and then those alternative investments often are just lumped together. So then we talk about some of the categories that you may encounter within each asset class, especially when we're talking about stock here. We're specifically talking about growth or value stocks in this slide. So a growth stock is going to be an expensive stock compared to earnings. The reason it's an expensive stock compared to earnings is because investors believe there's going to be high potential for significant growth. And so we're talking about firms like Apple that release iPhones. It's an expensive stock, but investors believe they're still going to continue to have explosive growth. Now, this could also be some startups that have even negative earnings at the moment, but there's a huge potential for a large amount of growth in that stock. So again, earnings are low compared to, the price of the stock, is high compared to the earnings. The earnings may be lower than the stock price justifies, but the reason is because there is a potential for a large amount of growth in that stock. Now, value stocks are stocks many analysts may consider to be on sale. It's lower priced compared to the earnings or the dividends or whatever the book value is. It's mathematically lower priced. And there's not an expectation that the company's going to have some skyrocketing prices very soon, but it's a solid stock that investors like to hold because the downside risk is also lower. And they may also generally have a very high dividend yield. So it's a steady stock that is not expected to explode, but it is not expected to tank either. So you've got a value stock that's paying a steady dividend. And so for those looking for a value stock, those are the benefits they will have from that. You could also have a blend, which is a stock that has some characteristics of both growth and value. But generally you're going to have clients who are looking for value, or they're looking for growth, and they want to allocate certain parts of their portfolio to growth and certain parts to value. So you'll be able to locate different stocks that meet those needs. You also can break out asset classes by their location. Now, when we talk about a U.S. stock, this means what it sounds like. The firm is based in the United States. Now, the ones that you'll want to clarify is the foreign developed and foreign emerging. So the foreign developed stock is meaning that the firm is based in a developed country that's not the United States. It has a well-developed economy, a generally accepted stable currency, as stable as a currency can be compared to the dollar. So there's an understanding that some currencies compared to the dollar are unstable, but in relative terms, this foreign developed assets means that the currency is generally accepted by the world and the country is developed. Now, foreign emerging is the riskier, more volatile stocks where the firm is based in a country that is comparatively undeveloped, the undeveloped economy, and which means their currency may not be as widely accepted and quite a bit more volatile than what we consider to be the developed country currencies. And this higher risk, as always with risk, the reason risks are taken is to get higher returns. So with these riskier foreign emerging assets, there's a potential for a higher expectation of returns. So consider when you're creating your portfolio for your project to look at both foreign and U.S. stocks and determine which fit into your client's expectations. And even within foreign stocks, consider the amount of developed foreign assets as well as emerging foreign assets and determine what's appropriate for your client. We can also look at market capitalization. A market capitalization is basically looking at the size of the firm. How big is it? How much stock is actually traded? So it's basically, by definition, the total value of a company's trading stock. And so you could take the number of outstanding shares times the share price, and that will give you the market capitalization. So if that turns out to be more than $5 billion, like maybe a Walmart would be, that's what we consider a large cap company. It's more than $5 billion in total tradable stock. A mid-cap company has a market value of 1 to 5 billion. That's considered a mid-cap. Then the small cap has total tradable stock or market value that's actually less than 1 billion. You might also at times see micro cap defined. Micro cap company means that it's just a really very small market value, and usually that means less than 300 million. That's kind of a moving target at what people consider to be micro cap, but it's usually less than 300 million in market value, and it's just a very small firm. So these are some of the asset categories and classifications that you'll want to look at and be able to identify in your portfolio project. And if you have any further questions about this or want to discuss it in the class discussion this week, we can talk about more of this there. And I look forward to talking with you and wish you a great week. Thanks.